So a long time since I did this, and because we've been looking at this topping process developing since the end of December, we've been mentioning the potential for an ending pattern, expanding, contracting. Is it complete? Did he truncate? And then he actually formed one more new high. And I did say early Jan, one more new high. So all of that happened, but it took a little longer. And so in the meantime, I did take a short break also from the markets. And that's why you didn't see a lot of YouTube shorts or videos. So for almost a week, I just went away quietly and disappeared for some while, and then made it back. And then there are Indiacharts insiders, subscribers who've been saying you're not been updating, so many wave counts that we used to do earlier across equities, and and there's a reason because since I don't run an advisory service, I feel I have the privilege to do what I think, which means that if I don't think it's the right time to say anything, I don't have to say anything. And it's very important to be able to interpret that as important information, because there are some times when it's not right to do something. It's just that you want to be sure, you want to sit back, you want to take note of everything, take a step back, maybe change something that you thought earlier. Is something right, wrong? And this is one of those moments, because sentiment measures, and this is sort of what we wrote in the long short report at the start of the month, and we've already prepared people mentally for it. So I don't know why they would not be prepared unless they just don't agree and definitely want an alternate opinion. And it's not that I don't spend every day thinking about, are we right or are we wrong, because there are narratives that can change the situation. And I spent quite some time thinking about it this morning as well. So I can tell you I don't know, but the best way to deal with it is look at the current setup and what it is doing on your charts. And so far, nothing has happened to change my thought of the topping process. But fundamentally, there are enough news items out there telling me that something can change. So let's first go over what can change, what I thought earlier, and then why we are here and what we are thinking about. So that should sort of give you an overall picture. So last year, I think at the peak of December, we had one sentiment extreme, and I prepared everyone saying that this may be the last chance to sell, because I had not seen such an extreme in a long time. And for some reason, the markets didn't fall very, very hard. They started to come off very, very slowly. There was only one metric which was actually telling us that there is extreme pessimism, even though all the others were telling us that there's extreme optimism. So whether it was positioning, FIs were long to their neck. This is December of last year. Premiums were at the highest we had ever seen in point terms, and even percentage terms, they were near the highs. So that was like extreme bullish. But that one metric which very few people follow is the volume-based put call ratio, and this is available on Strike. So if you have never looked at it, you should, because it's a medium to longer term indicator, not like the OIPCR which most people talk about. In fact, the CBOE put call ratio on the S&P 500 that is watched so actively is also a volume-based put call ratio. So you should be aware that the volume put call ratio is not only a medium-term indicator; it's also inversely correlated to the Nifty. Whereas the OIPCR, the open interest based put call ratio, is actually directly correlated to the Nifty. So having said that, the volume based put call ratio was actually heading up and staying elevated above 0.7, 0.8 for a long period of time. And this led for the indicator to be very, very high, even though when the Nifty corrected to 15,200 in July of last year, it did not really come down that much. It should have. It didn't. Yeah. So after that, when it rallied, So when it rallied from there back to 18,800 in December, at the top, the volume put call ratio should come down. It should show complacency. That was not happening. It did come down, but not that much. It was still in the zone of which is near market bottoms. And so that was one indicator which in Jan started worrying me, telling me that we shouldn't be too pessimistic, because even though positioning is saying it's long, the fall might not be too big because the volume PCR is still high. Now, eventually, over the last 9 months, the volume PCR has still remained high, and it probably tells us that maybe there is a regime shift or a range change happening in the indicator. We also started to recalculate it rather than taking it from the info kit that I used to get from Sherkhan to manually calculating it from the NSE files itself, just to make sure that the data is right. And this is what it is. So we are retaining those numbers now. Since we are calculating ourselves, at least we are sure that the numbers are correct. And so if this is the range, this is it. So we're just sticking to it. But it was high, and that was a reason to think that the fall may not be too much. And then in March we bottomed, right? So when we bottomed in March, the first thought is, well, then a new bull run should start. We have extreme pessimism in the US banking sector. Bond yields have been rising forever. The dollar started to fall again. So all the reasons I thought were good for a bull run to take off. And so I took that side of the bet. Even the mid and small cap indices were making a higher bottom than they had in June. And it was ideal. And so that turned out to be a brilliant 6-8 month rally. But as we hit October, once again the risks started to show up, right? You started to get bond yields attempting to rise again, and they did bottom eventually in October, but they were rising relentlessly throughout this period, even as the market was going up. So fine, bond yields were rising, but we are not worried because the inverted yield curve was, well, still inverted, and you don't know how long it stays. But in October, it started to de-invert, which means it started to steepen. Now, when it steepens and the US market started to fall, that's usually a sign that maybe you're getting close to the point that the market recognizes a recession. But that point is actually when you cross the zero line on the steepening of the inverted yield curve. Now, that did not happen. You didn't see the yield curve go back above zero. And so it remained a question mark. It looked like that. I got scared, and then the market bottomed out and started to go up. So I was open to the idea, fine, you'll retest the highs or a retracement or something before you come down again. And there was the extreme short position also. So that also gave us the reason to think that wait for the short squeeze to complete. And the next thing we knew, we are in December looking at an developing ending diagonal in the fifth, which has taken its own time. Now, what changed? So the start of the year bullish narrative was bond yields have fallen too much, US banking sector was maybe over. Some of that still looks true because US banking sectors remain suppressed. It hasn't risen as much as the S&P. And the monthly RMI is actually turning bullish. So I start thinking, well, then am I wrong? What I was thinking that, banking worst is over. Last year, maybe it just took time and it's bottomed out. Same with the Russell 2000. Now, there's a reason why the Russell 2000 in the US, which is the small stocks, are suppressed because the earnings growth is negative 20, 30, 40%, during the year in different quarters. So it's been a big negative number, and that's why the stocks have remained suppressed. So that makes sense for what has happened. But the question is what happens next? Because moment the Federal Reserve started to talk about lowering rates, the small stock index started to rally. So it's retraced around more than almost 60%, not 61, but close to 60% of the previous rise. And now, after having broken last year's lows, it's gone back to a 52-week high, right? So it swung back both ways. And again, there the monthly RMI, just like in banking, is turned bullish. So now if I look at those two factors and I say, yeah, I was thinking 6 months back that, if our market is good and these two bottom out, worst is over, then it's Goldilocks. Now the world is saying Goldilocks because of the Fed, and I am now thinking, is it because the yield curve inversion is still here? And I was trying to ignore for the first 9 months turning bullish the yield curve, and now I'm actually paying attention to it. And so a lot of people started to question me, why are you going back on what you originally said when it's actually happening? And I've had to spend a lot of time thinking about these things. So the fact here is that the US is a net big borrower. And if they are a big borrower, that means they have to come to the bond market and borrow more money. If they have to do that, that means bond yields cannot come down, no matter what the Fed says. So the only way bond yields come down, and so this is why I lost, I didn't give much heed to the idea that the Fed saying they'll cut rates. Okay, they're saying so, but they can't really do it unless they actually go back to QE, unless they get yield curve control into place, which means that interest rates will remain at this level and not go above this. And they'll do that only once they are confident that inflation is under control, because then they can't really keep yields suppressed if inflation is taking off. But if they don't put a yield curve control, at least can they start buying bonds to support the government? Now that is something, and that I think is the only thing that can bring rates down or keep them down when your net borrowing is going into trillions and trillions and you're still spending more every year and borrowing more. You have crossed the point where without QE support, can you keep interest rates down? So if you go back there, yes, you get you reflate all assets and you get a bull run and markets go higher. But if you don't do that, if you're not able to do that, then I think we will remain in a situation where interest rates remain elevated. We can ignore that risk for a while, but eventually high rates will slow the economy down enough to cause a recession. And already a lot of data is showing the slowing down. So the only reason markets are not reacting to that is because they started to believe the idea that interest rates will come down because the Fed is saying so. And for all you know, they may even do a QE because I don't know, I didn't read the minutes, but I heard an interview somewhere saying that they've inserted a line talking about we need to discuss the reversal of quantitative tightening also into the Fed minutes, which was probably there or not there, they are not sure, but it's there in the minutes. Now you can check, I haven't checked, but if that is true, then are they really planning to go back to QE? And if not now, maybe 6 months from now. And that is a reason why the markets are rallying. They're taking that as a positive trigger. So now I have the catch in, I am looking at, we've gone again from extreme negative sentiment to extreme positive sentiment as far as the Nifty is concerned again, which means October lows, there was a short position. And now in Jan, as this ending diagonal, which we are calling it, is developing, we have a net long position on the extreme side. And of course, some of it has unwound now, but just to tell you, the situation at the start of this month was extreme long. And so the sentiment in the immediate term, okay, for our markets was that this looks toppish. You have everybody long all over again. The December to January rollover was once again just like last year's November to December rollover. 1 month later, we have peak rollover premiums. So it is the same setup as we had back then when the market fell from December to March, except that this time it's starting in January, same setup. And then that setup resulted in FIs cutting back their longs, which they had built up, the market topping out, and eventually they went short. And a day before the budget, they were short. Now here we are, 3 days before the budget, and they've already turned short because post-expiry, they gave up all their longs for the Jan expiry. So now we have the same setup as a year back, that ahead of the budget, FIs are short. That time people blamed the short position because of insider trading in Adani. I don't know how true that is, but at least there was a short. Now it didn't fall too much except for intraday volatility on the Adani news. And then the market actually bounced a bit into early Feb. This time, what will it be? I mean, this is even a vote on account budget. So last year there was a capex increase. There was actually positive news in the budget. So it was an awkward situation to have a short position from FIs and have positive news from the budget. I actually thought the budget was good. So I was betting on upside, and then the Adani news was keeping it down, and then it did bounce and it looked like, okay, I'm right. And then it didn't go very far. It started to fall again. So that was the tricky part last year. This year, once again, you have a short position ahead of the budget. FI's market was trying to bounce yesterday, and now it stopped at 61% retracement today, gone back below the 20-day average. So the setup looks weak, prima facie. You have the longs unwinding from FIs. They are not an extreme short, so you can't say, okay, it's reached the extreme now, we have a bottom and you should go up. We haven't reached that point compared to the last two bottoms. But we have given up all the longs at least. That's one step is done. We still have premiums which were high in the Jan to Feb rollover. Not as high as December to Jan, but okay, they are still positive. And some medium-term indicators like the volume put-call ratio, again, going back there, is rising, but hasn't reached the level it had at the last two bottoms. So not extreme panic, but yes, panic is rising. So what do we do here? It doesn't look like we have the setup of similar to the last two bottoms. In fact, at the start of the month, and as I'm calling this, I've been saying seasonal top in January, you had all the readings for a peak and you're falling from there. And now you don't have all the readings of a bottom yet, which means that there should be further weakness ahead. The confusion is you have both the FOMC and budget meetings 2 days from today. And in the FOMC meeting, and that's what I'm more scared about. Budget is a no vote on account, right? Nothing new is mostly going to come out of there. In fact, anything, it could be negative if they manage to squeeze through something populist that costs the economy or the banks. It can be taken the other way as well. But if they can't, fine, that just goes through. What could turn out to be a negative is if the FOMC backs off from QE. But what could turn out to be very positive on the morning of the budget day is that they actually succumb to it and say we are going to start talking about QE. Last time they said we're going to talk about lowering rates. What if they start saying we'd start talking about QE? That would put fire under the markets across the world. And that is the only thing I fear, because apart from that, given the huge government borrowing, high interest rates, slowing economy appear like a given. And then it's just a question of when does the market react to that. But if you add QE back, then the bearish case can get pushed back significantly, because then you're again inflating everything endlessly with money. So that's, I think, that's the only argument. I think there's nothing much more to say. It's just come down to that. Will the Fed cross that line now or not? And if they don't do it now, if they say, okay, we'll do it 8 months from now, that too can, at least for some time, damage the economy or the markets for a while, because then your earnings will slow down to that extent. What we don't know is whether the talk of QE will then keep things elevated, because we'll keep thinking where they're going to do it, right? So you can't really sell the market too far, and so any sell off will then get bought into because QE is coming. So I think that is that's the net of the psychology. But in the near term, again, when we go back to sentiment readings say that we've been extreme bullish, which means everything looks that people are overconfident and over bullish on this market, and that is not a good thing as far as India is concerned. I'm talking of India specifically. Of course, the EW, I think that's the same scenario in the US as well, based on various measures. But I'll stick to India since that's the data where I have, where we are tracking. And that has not gone to the other side. So surely between now and March, we remain expectant of a corrective process, a downward move, unless proven otherwise. And nothing has changed on that front. So my idea remains, pay attention to the market setup, because the QE interest rate story will remain an unknown. They may just dice it around saying, yeah, we're thinking about it, we're talking about it, we don't know. And in the meantime, our own market has to do what it has to do. So, and it's about time it does unwind some of the excessiveness, because, I mean, the simplest, oldest indicator is volume. We have peak volume, which often can be a buying climax. I mean, it's the oldest theory. Prices rise with volume, prices fall with volume, with falling volume. So if prices fall with falling volume and rise with rising volume, when do you get peak volume? Closer to the highs, right? So, and that's what you're getting right now, whether it's in the Nifty 500 pack or whether it's in the PSU stocks, they're all seeing peak volume right now. And when you get peak volume, it's simply a sign that, another sign, one more of sentiment indicator, that you're in the excessive zone and that needs to cool off. So that's something I will definitely wait for. Whether the correction ends up being a small one or a big one, we can argue that part, but I'll still wait for a correction first before, considering the bull case. And that gives us some time to then figure out what is happening in the global macro space. Does it really change something? Then I have to change my view. But right now, since nothing has changed, I'm not guessing. I'm letting the information come in rather than me guessing. The only thing I'm saying is, so far we've only heard about interest rate policy, and that may not be enough. I need to hear QE. Then definitely there's a reason for me to change my view, and we'll do it based on the trade setup, market setup, rather than just, oh, ye news aa gaya, change karo. We'll look at what the trade setup is really doing. But that will help in changing. So that is the macro thing that will help me in changing that outset, that, yeah, now there could be a secondary reflationary cycle build up because the macro will change. So yeah, I think that sums up what I'm thinking about markets at this moment. And like I said, 2 days ahead of the budget today, after attempting a bounce, we've actually sold off from what looks like an island reversal gap zone above 21,850. And actually we failed at 61%, which was 21,750 odd. And so failure to cross 61% of the last fall looks like an X wave, corrective wave, which is over, and possibly you started down again because we closed below the 20-day average. But in 2 days you have a budget. Will you sell off immediately, or will you just hang around here till the budget? Now, like I said, if there's nothing going to come from the budget, on a vote on account, there's nothing more for the market to bite into. In fact, the only reason it went up yesterday, I hear, is because of the news around, some local events in Bihar and so on, where the government is getting additional seats. And if it's political reasons why, Reliance went up 7% and ONGC 8%, then that's a completely different gamble. But news-based moves, like I say, can last for a day or two. After that, the markets must make sense of themselves. In fact, not advised, but Reliance Industries has reached the top end of its rising channel, right? I've published that chart on Twitter. Let's see whether that resistance works or not. So if you just draw a rising channel, of course, this is an adjusted chart because, Reliance Jio Financial Services was demerged from the company. And if you adjust that demerger value and then adjust the chart and draw a rising channel, you'll see that Reliance has actually touched the top end of that channel. So that is the setup. And I was not sure when I had drawn this channel a while back. I was not sure what could take it up there. I've been bearish on the market. And then suddenly yesterday, pop, it just happened. and we've touched it exactly to the point. Funny things, markets have a way of creating magnets with trend lines. I've heard this, read this, seen it now, and this is what it is. So if that's what it was, then many times large caps like this, which are major market movers, they do tend to appear to be moving the market at that specific point of time, in the final stages, creating euphoria. It does happen, and that's why when you see something like that, we always want to wait one more day and say, see, yeah, is this real, or is this follow through, or was this a one day euphoric move, or a news based move? So far it looks like news based, whatever happened yesterday to the Nifty. And if it was news based, we want to see whether it turns out to be reality today or not. So that's all in this update from me today. Thank you.